Well, as the US closes out and looks ahead to the seasonal Thanksgiving holiday period, we see the S&P closing out the month about 5% higher. The Dow's up 7%. We've got the US dollar up 2%. We see the Japanese yen starting to find some traction. Gold closes the month down about 4% at the moment, and Bitcoin's up about 33%. But can it continue as we look ahead into what will be a very lively December in terms of the event risk? We've got payrolls, we've got US CPI, we've got a whole plethora of central banks who are expected to ease, with the market pricing in a conjecture about whether or not we get more cuts or less cuts. This could lead to a very lively December indeed. And we break it all down. We look at the trades that matter, are on the radar. So stay tuned. This is the trade-off. Well, hi there. My name is Chris Weston from Pepperstone, and I'm going to be joined in 2 seconds by Blake Morrow from Forex Analytics. And we will be discussing everything that's going on in the markets, where we see the direction of travel, the risks in the markets, how we should manage those, the setups that are front of mind, the flows, the movers and shakers, and we break down the trades that we like and the direction of travel, as I say. Mr. Blake Morrow, coming to the program. I want to talk to you Thanksgiving, gratitude for everything that we have that works in our life and for our family and friends. And we got gratitude for you, Blake, for sticking around and giving us your views this year. It's been fantastic, and obviously people have got some great value there. So thank you for that. And what are you planning to do for Thanksgiving this year?
Well, we're gonna be traveling a little bit for Thanksgiving, and I want to give thanks to all of our to not only your staff there at Pepperstone, but all of our viewers as well. This is the time of year us Americans, we like to reflect on what we are thankful for, and I'm thankful that I think we're going on 3 years of this show, and I'm thankful for it. I enjoy thoroughly the show and analyzing the markets with you, because you bring up a lot of things that I wasn't necessarily looking at. And I think that's true probably for a lot of traders out there. So thank you. And thank you all for tuning in every single week.
Cool. Well, I hope the Morrow family has a great holiday. And for anyone else out there who's celebrating out there, we hope that you have a safe and merry Thanksgiving. Can you use the word merry? Is that the right term? But I hope you have a great time anyway. Anyway, let's go into topical thunder and see what's going on in the markets. Let's go to December risk, because I've pulled up a chart which we're gonna chuck in and you can see. But I want to talk about December, Blake, because obviously we're closing out November. We look ahead as traders. We want to understand and as traders, investors live in the future. I like to think we live more in the present. We trade what's in front of us at that time, the aggregation of flows, behaviors, all beliefs that are coming through in the price action. We trade what's in front of us now, the volatility, the trend. We're seeing mean reverting markets. It's what we put in front of us now. But we do look ahead into December and we say, what is the propensity? What are the event risks that we see that could cause bigger moves? Now, obviously, we've got the macro factors. More tariffs are probably more likely to come through. Relative growth rates, geopolitical issues. Although, thankfully, we're seeing some more positive and constructive headlines of late. But I want to talk about the central bank side of things, Blake, because I look down at this chart that we've got in front of here. It's a bit of an Excel job, but you can see all the central banks that are going to be meeting through December. Obviously, we've just seen the RBNZ cutting 50 basis points, and they're getting closer towards their trough rates. But look, we've got, take out Australia and the UK, which meets in sort of mid-December, and they're not expected to do anything. They're both expected firmly to keep rates on hold. But I look at Canada at the moment. And they've got obviously GDP numbers and jobs numbers coming through, but the market's pricing a 25 basis points as a given for that meeting. And there's actually a 1 in 3 chance that we get a 50 basis point cut. You go to Europe and we've got a 16% chance for 50 basis point cut. Obviously, this is going to be conditional. We'll see what happens with the CPI numbers later this week in Europe and some of the sort of regional numbers there. That could increase depending on the outcome, obviously, the chance for a 50 basis point cut. In the US, we've got... the opposite's true. Could we see a hold or could we see a 25 basis point cut? At the moment, the market's pricing 17 basis points or a 2 in 3 chance that we get a 25 basis point cut. And Japan, there's a 50-50 chance they raise rates by 25 basis points as well. So, we go into this month where sort of 5 or so central banks are expected to ease. And there's actually conjecture whether they, in terms of the pricing's line ball cool. And we've got in the US, we've obviously got payrolls numbers that come out on the 6th of December. If they're weak again, that could increase the probability. If they're really strong, then obviously that could lower the probability. And then we got CPI numbers coming out on the 10th or 11th. So what I'm trying to say here, Blake, is that we've got a whole raft of central banks coming through, some key data, and the market sort of torn between the actions, which suggests to me in a period where we're going to get reduced liquidity, that we could see these dynamics mean we need to be on our toes, especially for FX and rates traders. So, I think we're in for a potential December with a lot of landmines still to come. How are you seeing this?
You pointed out just fine, and I love the schematic you put up there. Even though it's an Excel spreadsheet, it's great because it really shows you the dynamics and the divergence between some central banks. And just remember, all this data that we're going to be getting is really crammed in the first 3 weeks of December. So it is going to be a lively
December. Lively. Yep, I reckon.
Lively. And you did mention it briefly, but I do want to say that, and we're going to talk about the dollar because I think the dollar is at kind of the epicenter of everything. Next week, and I know we're going to have another trade-off before this happens, so you're going to hear us talk about it again next week. But next week, we're going to get the jobs report, and the market or economists are expecting that the U.S. is going to create, somewhere between 10 and 20,000 jobs. That's really close to missing. You could miss that number, have a negative print, and that's going to weigh on sentiment. So it's Chris, there are a lot of landmines, and it is going to be lively, and it's all going to be in a short period. And as you pointed out, liquidity is going to be very bad. So that actually brings us to like our next topic, which I want to talk about, and I want to talk about trading in this trading environment. And not only the next couple of days, because it's the Thanksgiving holiday, but it's just the lack of liquidity that we're going to see. But let me take a moment just to speak about Thanksgiving. And by the way, I am driving out of town. Like literally, by the time some of you are watching this, I'll be gone. And there's a lot of traders that are traveling in the United States, across the country, different places, to spend Thanksgiving holiday with their family. Liquidity is going to be poor. I remember Thanksgiving holidays where the day after Thanksgiving, one of the Middle Eastern markets completely collapsed. I believe it was in Saudi Arabia or like in Kuwait, something like that. I've carved up turkey and on Thursday, which would be tomorrow, and I've seen 300 pip moves in the euro. When there's a lot of flows, like we have a lot of end of month flows that are still being pushed through the market for the next couple of days, if there's no liquidity and those flows need to get done, they're going to get done. And if there's not somebody on the other side of the market, you could see these moves really accelerate. And you get that in the month of December too, because at the end of year, after having a 30% rise in the S&P, like literally 28% over the course of 2024, the end of year flows are going to be massive, massive. So what does that mean? Put it all together. Hey, look, I always live by this rule. It's okay to be wrong. It's not okay to stay wrong. And definitely when there's no liquidity or a lack of liquidity for the next few weeks, look, if you're on the wrong side of something, get out, because it could get worse. I've been there. But Chris, I wanted to talk a little bit about the trading environments we're going to be witnessing. What do you have to say about that?
Yeah, I think, the liquidity is obviously going to be a thematic. I mean, you'll get out of the trade, you'll be able to move an order, but you're just going to move the order book a little bit more. But I think, we go into December, and this idea about Chase, certainly it's an equity thematic, and that whole idea about a seasonal Santa Claus rally, that is purely predicated on the performance of the S&P and the NASDAQ going into December. Statistically over the last 20 years, if the S&P is up over 15%, 90% of the time you see the S&P higher in December. And that's because you've got those active managers who have to benchmark themselves chasing the performance into the end of the year. And obviously if the S&P is at 3% performance year to date, then people will just probably lock in performance because there is no performance. But the S&P's had such a ripping year that you're going to get active managers who are slightly underwater. If the market goes up, they need to not only be in the market, they need to increase risk to be above benchmark returns. The thing that counters that is because we've had such a good year, you do get a lot of pension funds and portfolio and mutual funds that will need to rebalance, and that means selling. So you've got active managers who have to chase, and that's obviously positive. And on the flip side, then you're going to have a lot of these mutual funds that will need to rebalance. The question is will they do it this year, or do they wait out until next year, hoping they can net out a bit more return? So that's another factor. But yeah, look, this idea about Santa Claus and chasing is really predicated on how the S&P's performed, and we've had an absolute stonky year. So active, if you're underwater, you've got to dial up that risk in December if it keeps going up. But what's interesting, as I'll go into the dollar now, is that tech is now tech lacks a catalyst, and for the index to really make a stage higher this year, you're going to need to see semis working, and they're not at the moment. They're sort of missing a catalyst and they're going sideways. So why would you want to chase those stocks? The Nvidias of this world, the AMDs. If the semis, everyone wants banks, everyone wants some cyclicality, but it's the sort of more defensive REITs that are working well, utilities working well. So for the index to really make a staggering return, you're going to need to see Nvidia fly. You're going to need to see Microsoft fly. We're not seeing that at the moment, so we'll need to see that happening. But it's going to be an interesting one, obviously, with central banks as well. So but keep an open mind and be a slave to the tape is the idea. Let's go into the dollar. Sorry, I've been taking up a bit of time there.
Well, actually, we've been in the dollar already. So
I think that's my producer with his taking the wrong cruise with his trigger finger. Anyway, let's just go into the dollar, because I think personally, tactically, the dollar's got some downside in the short term. Now, we talked about that chart which showed all these central banks who are pricing in a bit more. For me, the Fed are going to cut rates by 25 basis points. Obviously, it's going to be conditional on payrolls and all these factors. But I don't think the ECB are going to have 50 basis points. So, obviously, we'll have to see what happens with the inflation numbers. And it's a big what if. But I think at the moment, my base case is that the ECB cut 25 basis points. And as we saw from the RBNZ yesterday, when they priced in a little bit more of a 75, they didn't deliver the 75 that the market had been pricing in. We saw a massive move in the Kiwi. So maybe the same things are true. The world is long of dollars. We're looking at the Bank of Japan maybe looking to raise rates. We're seeing the yen respond. Dollar yen's come down below the levels that we saw, from the election. A bit comes out of some of this pricing in Bank of Canada, ECB, all these other factors, and therefore tactically it makes me say that maybe there's some short-term downside in the US dollar as we reprice those rates markets. How do you see that?
Well, I'm seeing it just like you, and I'm actually a little dollar heavy on some of the setups, so I'm going to kind of reserve myself a little bit. But this goes back to what I just said a moment ago. I think that this jobs report this next week, and again, we're going to talk about it again next Wednesday, but the jobs report I think is going to be crucial to the dollar. I think everybody's pretty much in unison that inflation is getting a little sticky, but if the labor market starts to show signs of weakness and we have a jobs report where we actually lose jobs, and
can I just jump in? I just want to say I'm just looking at the Bloomberg consensus now, and there's not many, but the consensus now for payrolls is 200,000. That's what I'm saying.
200,000. I thought it was 12,000.
It might have changed because everyone's still got to put their views in. All the economists are still doing, but the current consensus on Bloomberg now is 200,000. So a nice snapback as obviously some of the port disruptions and weather-related issues come back out.
Okay. All right. Well, I was looking at data from earlier today, but it doesn't really matter. The fact of the matter is the jobs report will matter. That's what I'm trying to point out.
Exactly. It will, definitely.
It's going to matter to the dollar. It's going to matter to probably the overall direction. I think that the dollar has been sold. We've seen this like false breakout, and that's concerning if you're a dollar bull. And but the flip side is, there's a couple of things. The CFTC data is as you pointed out, very long of dollars. You can see the market's very long of dollars. So there could be a lot of unwinds. And remember, talk about end of year flows. If the stock market is just everybody's chasing, they're going to be selling dollars to do that. And so I think the dollar is in a pretty precarious situation. But anyway, I know we talked a lot about the dollar, and I need to wrap things up and move it to our last topic, which is about the man of the hour,
the great man,
who's going to get the Nobel Peace Prize when he brings world peace to the center stage.
He's already won it 4 times.
Well, Trump. I wanted to talk about President-elect Trump and just the fact that volatility has come early and it's here to stay, guys. I want to talk a little bit about this because kind of with the other topic about trading and lack of liquidity, Trump is an enigma of sorts when it comes to the markets. And, These headlines come out fast and furious. For example, you guys were up in the morning already a couple of days ago when he named Bessent as his Treasury Secretary. And it was actually on a Friday after the market had closed. The dollar responded. We saw gaps. And then the very next day, as he brings in somebody like Bessent, who is going to be more, tariff friendly, if you will, not push as hard on tariffs. That is the theme. The dollar sold off. And then not even 24 hours after the market was open, he then says, we're going to, implement 25% tariffs on Canada, Mexico, and on oil imports. We want to, curb fentanyl and illegal immigration. All this stuff that is completely opposite of bringing Bessent in. The dollar turned around and ripped, and then turned around, and it's obviously been a lot of volatility. It's been very, very scary type of trading environment. But that is Trump in a nutshell. And what I learned, and I'm going to pass it over to you, what I learned over his previous 4 years as president is I can't really hold on to swing trades unless they're really in the money. But how do you see this Trump volatility playing out the next few years?
Well, I think it's pretty confined into the FX space because bond volatility has subsided and the VIX is now trading at 14%, and it's come down below sort of 20-day realized volatility. So yeah, we have seen a noticeable pickup in statistical levels of FX volatility, and partly that can be down to Trump, and partly it can be attributed to the fact that we are seeing clear divergent setting from central banks expected. When you get all central banks acting as one, all cutting rates, similar tunes, you get suppressed volatility in the FX markets. When you start saying 2025, the Fed are going to be doing one thing, the EC are going to be doing another, the Bank of England, the Bank of Japan, the PBOC are going to be doing different things. That's when we get dispersions. That's when we get trends coming through in the bond market, and that's where we get higher volatility. And we're seeing people price that now. So you're absolutely on the money with that one. But Trump's assembled his team now. We've got the trade representative, Jamison Greer, Bessent. He's established his team around him. And I think what he's shown with tariffs, and it's tariffs and immigration that he's going to go to from day one with inauguration, is that he's not going to mess around. I mean, the big difference between Trump 2.0 and Trump 2016 is he wasn't really prepared in 2016. I don't think he expected to win it, to be honest. But he knows exactly what he's got to do. He's got a great team around him. Or I can't say that, I'm not political, but he knows what works. He knows he's got the legislation on board. He can go from day one, and he's coming hard straight from day one. And those tariffs on China, he's adding an extra 10%. They'll continue to go up, and we're probably going to get another one through December. But he's not messing around. He's not here for a haircut. And he's been forceful. He's got a big team, strong team, and a knowledgeable team around him. And I think that those tariffs will increase volatility. And I think China's the big interesting one, because if you have a look at, everyone's talking about this idea that the yuan depreciated 11% in 2018, 2019. But it wasn't until the tariffs actually were implemented. A lot of the time we try and price things in earlier. We say tariffs are coming in, let's start selling this, that, and the other currency like we do with the Mexican peso. China's a different beast, though. China waits, because it's a managed currency. They wait until the facts happen. It's actually implemented. And then what we've seen is that they start to depreciate the yuan. So I think that's going to happen, but it won't happen until they actually happens on the 20th of January. And I think you're going to see a much weaker yuan, and that's going to increase. If we were to see that trend, again, that's just going to perpetuate volatility in the FX markets. But and I, Blake, we love volatility. What we don't love is what we don't like. Well, I don't. What doesn't? It depends on your trading style, of course. Is up one day, down the next day. I want some momentum in the market. So I want some actual rate of change and a continuation of that trend. Up and down one day is a tough one to do. So we love vol, we love volatility, we love range expansion, but I also love a bit of momentum and trend to catch on with those swing trades, as you talked about. Anyway, Trump brings volatility, also changes the way that we communicate and receive information. So we've all gone out and changed, looked at social media and Trump.
Everybody got their Truth Social
exactly,
profiles.
Yeah. That's the way. Anyway, let's go to the charts that matter. Let's go to that's the setup. Yeah, Blake, I feel like we're a bit old to be messing around with all these different social media channels these days, but that's the way of the world. And the algos will receive them and trade it much quicker than us anyway. Let's go to Buy America. I want to go to this idea. It's something I've been pushing for a while. You know, I think this is now a massive consensus trade, and it's a worrying consensus trade. And you know, I'd love to hear everyone else's views out here, but yeah, this is a trade that I've been pushing for a while, and it's the idea of being short Europe, long America, and we're doing that through. You can do that through euro dollar. Obviously, we've seen euro dollar trade into 103.30 odd or so, and it's snapped back a bit now. But certainly from an equity perspective, you know, you can go and have a look at France, which has got all sorts of political issues taking place at the moment. Yeah, collapsed governments in the making. But yeah, we've got euro stocks as your sort of classic benchmark there, and you know, as it's going down, you know, you're seeing the S&P outperform as the denominator. Now, I think we're getting to a point where this trade is overdone. There's not a lot to like about Europe, to be honest. From a growth perspective, the ECB have still got more work to do. The Fed may look to hold off because we could see a strong payrolls number. But let's see what happens. But I think we are getting to the point now where over the last 6 months, the differential in performance is about 20%. Now, if you look over the last 20 years, whenever we've got that 20% 6-month underperformance, you know, you have seen a snapback. And the sample's not massive. There's like 5 or 6 different occurrences. But I think there's so much negativity priced into European stocks that I feel like we're getting to a point where we might see a tactical rally and a bit of outperformance in European equities. I'll wait till price tells me to push into the trade. But this is a trade I've been pushing for a long time. It's been working well. Everyone's in the trade who are doing long-short strategies. I feel like it's probably got to the point where we take profits on that trade, but it takes a brave man to be going long Europe and short US. But I feel we're getting to that point where tactically it could happen.
Wow, that is definitely an established trend, Chris. Well, you know, selling Europe on rallies does make sense to me. All right, well, my first setup is going to be the Kiwi, and you know, first thing I look at when I look at this chart is this is an impulsive move. That was following the RBNZ, you know, last night. And if you think about what we've been talking about throughout this entire show. Hey traders, I apologize for the technical difficulties that we've had, but Westy and I, we did not want to leave without giving you our plays of the day. So here they are.
Now, my play of the day, I'm looking at Aussie yen. We have seen that technical break. You know, Aussie yen has been moving sideways in this sort of short-term consolidation period for a couple of weeks now, and we've seen that downside break through 99.40 odd. The question is can this kick? Now, of course, this trade, like any trade, comes with risk, and that needs to be managed. But I think the market has started to warm up to the idea that the Bank of Japan are going to be looking to hike rates in December. It's sort of 50-50 price, and obviously if they don't look to hike by 25 basis points in the December meeting, then they could go in January, and they may even look to do it in increments of 10-15 basis points as well. But certainly the market is warming up to that idea, and this is going to be conditional on the the Tokyo CPI numbers later this week, because Governor Ada has effectively told us they are looking to hike rates, and it's going to be data dependent. So we'll see what happens there. But we like this trade because technically it has broken down. The question is can this kick to the downside? And I think that move, if it does to break down, is there for chasing. So I'm looking to sell into weakness. If this kicks lower, I want to go for this because this is quite a meaningful technical break. Now, the other factor is what happens with China. We are seeing a bit of a rebound in the Hang Seng and some of the Chinese equity markets, and that is usually quite good for Aussie yen, but we'll see what happens there. We are seeing that yen re-emergence, and that's definitely something we need to watch. The Bank of Japan could be looking to raise rates, and I think this technical breakdown is one that I want to chase. So this is my play of the day today.
All right, so I want to take a little bit and talk about my play of the day, which is the pound Kiwi. You notice that we're developing this bull flag pattern. Now, the bull flag pattern, it was the bottom end of the flag was actually tested, and this was tested following the RBNZ. But you notice how we were talking about sterling and about UK rates and how the Bank of England might not cut rates. This might keep the sterling well bid. And so a move above flag resistance that comes in at 216, that's going to be pretty bullish. As long as we stay above 213.80, I think the flag stays intact, and a bull flag could take us to new trend highs above 218. So that's my play of the day, pound Kiwi. Good luck. All right, traders, that's a wrap for us at The Trade-Off. If you like this video, make sure you give us a thumbs up, subscribe to the channel, and don't worry, we'll be back next week for The Trade-Off.